This is the second time in a year that we've seen London having serious problems, and this is the world's largest and most liquid metal market. When London has a problem, the bond market is going to have a problem, the banks are going to have a problem, and the financial system is going to have a problem all at the same time. So I would agree very much with your point that if you don't directly hold it, you don't own it.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 17th through November 24th, 2025, while supplies last. First this week, backdated 1-ounce gold buffalo are just $320 over spot per ounce. Next, pre-1933 MS63 $20 Liberty coins are just $150 over melt per coin. And finally, 1-ounce 2025 Silver Eagles are just $7.85 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is David Jensen, mining executive and precious metal analyst. David, thank you so much for joining us today.
Good morning, Elijah. My pleasure. It's always good to talk.
Well, it's great to have you today. Last time we had you on, we were seeing massive backwardation in the silver market and shortages in London. Some of that seems to be relieved at least a little bit. Your perspective on the current backwardation we're seeing, and also what's happening in the silver market in London, kind of an update on that.
Yeah, so at the end of September, the LBMA, which is a trade association, releases statistics on silver holdings in London. And according to their figures, at the end of September, there was 140 million ounces held in London that weren't assets that belonged to the exchange-traded funds. So that represented what I call the float, or what could notionally be available to market. 10 days after that data was posted, the London market had a coronary, and a minor coronary in terms of stopping trading for about an hour and a half on October 10. And then that's despite the fact that there was 140 million ounces notionally in that market, but the market seized up because there was insufficient liquidity in the cash market. And then at the end of October, the LBMA published further statistics indicating that 54 million ounces had been added into the London market. So October 10 was actually a very important day because everybody had speculated about what silver was actually available to market versus what was not held by ETFs. So the portion in London not held by ETFs was 140 million ounces at the time. And what that told us was on October 10, and what that told us was that the free float on October 10 was zero. So in and around that 140 million ounce level is the critical level for London. Now, the shot of 54 million ounces since then into that market has given a temporary reprieve. But I think the most important thing to see from these data is that London is the world's most important physical silver cash market. And but what's essential to understand, I think, is that London is operating on a silver in, silver out basis. It can deliver silver into the market as long as it's getting deliveries from other places. There's no large repository of silver in that market. And according to the LBMA, on an active day, they're seeing over 700 million ounces per day of these cash contracts being traded in London for immediate ownership and immediate delivery. So if you want to call them promissory notes, it's a term that I've been using because that's what they are. But if maybe more in the vernacular would be to call them silver or gold debt notes that are being traded in the cash market. And they are basically promises to deliver physical metal within a couple of days into the London market to the holder of these notes. But they are for immediate ownership, and the concept that they're trading 700 million of these a day. When there's a global deficit this year, I think in reality it's going to be pushing 300 million ounces in a 1.2 billion ounce market. It tells us just how terrible the liquidity is in the global market.
So going forward here, what does that mean for the price? Because a lot of people are predicting a possible further pullback in silver. You know, we're down from the $54 highs that we saw in October, and we retouched that level. And we went as low as 45. Some people are calling for even $40 silver or whatnot. So your perspective on that, given the fundamentals out there, what do you anticipate in the coming months?
Well, there are really two massive overhangs in this market, and one is the open claims standing in London, which are of the order of a couple of billion ounces of silver in the cash market. And the other problem that we have globally is that we're continuing to see these supply deficits. You know, it's a 1.2 billion ounce per annum market with a mine supply, which is new silver being injected into the market, which is typically sold by the miners to generate cash, is only of the order of 825 million. So we've got this situation where there's got to be continual supply of stock into the market to keep it liquid. And so between the massive amounts of claims standing in London and the continuing deficit in terms of supply to the market, I am not seeing any fundamental reason that silver should be going down. In fact, I think what we're going to be seeing is a continual squeeze in this market. I think we see that the market players are positioning themselves for delivery, recognizing the situation, the industrial users especially, who absolutely have to have the metal. But there's another thing too, Elijah, that in terms of an indicator of how dire the situation is, and that's the SLV exchange traded fund. The ounces held by the SLV this year have gone up of the order of 10% in terms of their vault holdings. That's the iShares SLV ETF. And yet the price has gone up by 65% this year. And I don't think any market analyst out there would say that that is a reasonable correlation between those two numbers. When you have that level of interest surging into the market in terms of price action, you would expect to see a much larger increase in the open interest. So I think that's a third indicator of fundamentals that tell us that this price at the current level is unsustainable and that it needs to go higher, and I'd argue much higher, in order to generate the recycled silver to come into the market, to go through the refineries and be converted into the correct fineness and into the 1,000-ounce bars that these exchanges need. But the time needed for that is not weeks, but months and years to see sufficient volume being generated. So if you believe in supply-demand driving the market, and in fact it does when you're in a squeeze situation, as we're in right now, I don't see a scenario where the price can go down for any length of time. And in fact, I think it should go much higher in order to generate enough metal into the market to resolve the shortage issue.
And this, I guess, brings us to, I mean, the fact that we're seeing backwardation and still issues in London, does this have to do with a lot of people have talked about how if you don't hold your silver, you don't own it, right? And when it comes to these huge exchanges where it's kind of promissory notes people trade, what is your perspective on that? And people investing in the silver market, playing with ETFs or futures contracts and stuff like that, is that a secure way to own the metal, do you think? Or do you think people should own the physical instead?
Yeah, well, I mean, London trades these cash contracts, which in it, by the way, it's the world's largest silver and gold physical market in the cash market, which is immediate ownership and immediate delivery. And these contracts that are traded, I mentioned earlier, they're promissory notes, but they're really debt notes. They're silver debt and gold debt notes that are being traded. And the creation of these promissory notes or debt notes is infinity. And the only thing that stops that from happening is when there is demand for actual delivery of the metal into the market. Back in 2013, looking at LBMA data, they were trading 2.5 billion ounces of silver every day in the cash market in London. Now they say it's of the order of 700 million on a busy day. So I don't know how reliable those numbers are. They come from a platform that's operated by 4 major bullion banks, each of which has been convicted of fraud at one time or another. So, I would argue that the only certain thing is to have the metal itself, given the uncertainty that's created by this leveraged market and by the very recent health problems that we've seen in the cash market, both on October 10, when trading ceased, and even back in January and February, everybody was talking about gold delivery being delayed, but silver delivery was also being delayed of the order of six to 8 weeks at that time. So this is the second time in a year that we've seen London having serious problems, and this is the world's largest and most liquid metal market. So I would argue that when London has a problem, the bond market is going to have a problem, the banks are going to have a problem, and the financial system is going to have a problem all at the same time. So I would agree very much with your point that if you don't directly hold it, you don't own it.
And this brings us to another topic that has been on a lot of people's minds recently, is the form of precious metals to hold. We're seeing kind of an anomaly recently, and it's interesting. So what we're seeing is huge discounts on junk silver, so 90% US coinage, and that has been a very popular product for people to own because of its visibility and its potential for maybe to be used as barter if we got to that point in the future, because it's a US product, very recognizable. But with the issues of refineries really backed up right now and the demand for pure silver, what is your perspective on that? Because I know in times past during COVID, during the bank crisis 2023, we saw huge premiums on junk silver because people wanted that. It's kind of a preparedness item. But right now, that's not what we're seeing. So do you think it provides an opportunity for people to get into junk silver, or do you think the market going forward is going to be more for the pure silver variety?
One point before we dive into that is the whole view of using silver payment or gold payment as a form of barter. Gold and silver have a 4,000-year history as money. And what we're seeing now with the use of silver for payment, and I've mentioned before to others that I've seen in a local market near where I live, that people are actually starting to use silver in exchange for goods at a farmer's market. And so the use of silver and gold for settlement is that these are actually money versus the currency, the fiat or artificial currency, which is created by government edict. So we're seeing the silver and gold starting to circulate in a parallel payment system. And it's very much a competitor for the currencies which the governments and the banks create. And it's certainly not a welcome, I think, on their part to see the populace voting with their feet to use this. Now, in terms of the discount that's currently being experienced in the market for the constitutional metal, the 90% in the US and 80% pure silver in Canada, the refineries right now are experiencing extreme demand from the bullion banks for delivery of these 1,000-ounce bars from the refineries to be delivered into the market due to the increasing demand globally for silver and the very large 300 million ounce deficit this year. I think it's going to be larger than that next year. We'll see with time. Many people are saying, oh, it's 150 or 200 million, but every indication that we see is that the demand for the actual 1,000-ounce bars delivered into the refineries is getting out of hand. And what the refineries are doing is that they're turning to as much near pure silver or pure silver as they can get to refine into and pour into these 1,000-ounce bars for deliveries to the large market players. They have a fixed throughput volume capacity. And if you're putting through 80 or 90% pure silver, it eats up your capacity to produce silver. If you start with a higher grade stock being entered into the refinery process, you can elevate your output and meet the extreme market demand that we're seeing, indicated by the lease rates in the market and by the price backwardation, which continues to this day.
So it definitely at the moment, I think, is kind of a monetary, it's a question to people who are looking to get silver, is a monetary question. Do you want it for barter, or do you want it maybe as an investment vehicle at the moment? But do you see any, I guess, opportunity in the junk silver space, like that the premiums could reverse in the future? Or do you see that the market has fundamentally shifted in this regard?
I think the demand going forward is just going to increase as our financial situation worsens. I mean, you got a $320 trillion global debt market, and certainly the discussions that we're starting to hear on the mainstream financial networks, they're openly talking about larger and much larger allocations of real assets, especially gold and silver, into your portfolio. So I look at this as really a temporal or a short-term effect in the market, as an artifact of just the short-term inability of the refineries to source enough high-grade silver, at the same time that the retail investors are relatively asleep. But the retail investors are not going to remain asleep as long as this tremendous supply-demand imbalance exists. The demand is through the roof, and the supply just can't meet it from the regular sources. And the retail investor is going to wake up at some point, and even if the refineries don't want the silver, there's going to be a lot of retail investors, I believe, who are going to step in and be looking for delivery of the very valuable constitutional silver, in terms, as you mentioned earlier, being recognizable and in smaller units, readily available for trade settlement with constitutional money.
I think that's a really good point there. And it's crazy that they're not making more of it, and the supply is just dwindling as some is sent to refiners and everything.
Governments and the financial industry do not want you using that using silver and gold for trade settlement. They're moving to a digital system which can be fully tracked and fully controlled. But I think even more important is that gold and silver, they don't make the currencies, the inflating currencies and the devaluing currencies look very good. And the public is going to recognize that I call them garbage government currencies, but they're producing digital trash. And as it becomes more and more visible, more and more individuals in their trade will be asking for that type of payment in settlement. And this might sound like an extreme case, but if we look at the book When Money Dies by Ferguson, he looked at Weimar Germany, and many were unwilling to accept the inflating currency and were demanding gold and silver settlement. And I think that's the issue right now, is that the financial industry, who basically operate the governments, are trying to get everybody into a fully digitized system with all assets on the blockchain and under the control and oversight of the financial industry and the governments. And, along with digital IDs and I think social credit scoring systems, et cetera, this is a central planner's dream. And what gold and silver do is they do an end run on this plan that's being effected. And for that reason, I am quite happy to see the fact that the refineries aren't accepting that constitutional currency and that it's still circulating out there.
Certainly. And I think that's another sign. You mentioned how the retail public really hasn't jumped in yet. I mean, maybe, over the last month or two, we've seen a little bit of increased demand at Miles Franklin, but I would say it's nothing like we saw during 2023, during the banking crisis, or during COVID, or during silver squeeze. So it's really a sign that, people say that during the third stage of the bull market, the retail public is going crazy. We're just not at that at the moment. Maybe we're at the beginning of that third stage of the bull market, but we're certainly not a blow off top, at least if you look at what's happening in the retail market.
What is your number one demand right now? What product?
Well, I mean, I think the premiums show that there's a significant demand for silver eagles, although that seems to be maybe cooling off in the last couple of weeks, but not too much. And I think if you just look at some other indicators as well, like the gold-silver ratio, or if you compare silver versus the Dow, other factors like that, it really points to the idea that, as you've been saying, that there's still a big move ahead for the precious metals.
Yeah, when you look at global debt at $320 trillion, and then recognizing that the world's primary gold and silver market in London is a gold debt and a silver debt or promissory note trading system, and that it's been inflated as much as the global debt has been inflated, you don't have to look very far into the numbers to recognize the potential here for extraordinary moves in the value of these. And I think ultimately that many sources will demand these assets for payment to the exclusion of the fiat digital currencies that are out there so far, and then the new highly controlled ones that are about to be introduced.
Certainly. I mean, I think it's a shift that many of the people in this space have been predicting, and it's just what happens throughout history when governments create a currency, debase their currency, create paper currency. It seems to be almost always that it falls to a value of zero, and what emerges is real money again, gold and silver.
Exactly. I mean, even Greenspan, the currency printer himself, I mean, his quote that stands out is that he said, in extremis, or at the extreme, fiat currency is always rejected, and gold and parenthetically silver are always accepted. And I think that's what we have to keep in mind, that these guys know. They know these systems fail, but they're just way too much fun in terms of being able to blow bubbles in the financial industry and then run endless government deficits. And I would add fund endless overseas war campaigns as well. They just love it too much. And as soon as the average person, even at the margin, starts to wake up to this fact, because of the leverage in the system and the very, very small amounts in terms of the cash value of these amounts that are available at the exchanges, very small amounts of demand for delivery basically sets off the whole finely tuned leverage system that's been created that has really suppressed the price of silver and gold by creating these enormous amounts of claims for metal that just is not available to market.
Now, going forward here, obviously, it seems like we're in an acceleration phase for the precious metals. What are the key things that you're going to be looking for to signal that, we are entering a blow-off top phase? We are entering, we're on the tail end of that third stage of a bull market. What are the things you're going to be looking for in the coming months and years?
Yeah, I'm not anticipating a blow-off top per se. What I'm anticipating is an accelerating reallocation of assets from the financial system into a very, very limited sphere of physical assets. So what I'm following most closely is the implied lease rates, the pricing structure in terms of backwardation. When the spot price or the cash price is higher than the futures price, it indicates an eagerness and a demand for physical delivery, which in the cash market, in the immediate market, which outstrips future promises for delivery, despite the storage costs and insurance costs and the cost of capital that's necessary to allow for future delivery. So those are kind of the two key things that I'm following. I'm also following these ETFs. It's very unusual or strange to be seeing these run-ups in gold and silver, especially silver, and the fact that very, very muted increase in the holdings of the ETFs. And I think that further speaks to the shortage of physical metal available to market. And even the borrowing costs of the SLV shares there last month, around the October 10th, London market failure date, it was soaring over 30% per annum to borrow the shares. So clearly somebody was looking to get shares and to secure the physical metal as authorized participants in that market. So, and we also saw, by the way, Elijah, an overnight de facto a lease rate of 200% on October 10th and 11th. So that was the actual lease rate, not the implied lease rate that's calculated. And so that's what I would follow. I'd follow especially the London gold market. It's an immediate delivery market. And I think that's where we're going to get our foremost signal of the distress, which I see building here. I know that we're seeing the price pulling back from 54 to 50. It dropped as low as 45 there last week. But I think this is just a pause. These things, as these structures fail, you tend to see waves of activity as natural systems display in general. And so we would expect to see waves and surges of demand and price movement, and then lulls for a short period, and then a resurgence again. So I think there's a lot of players in the market that they recognize the door is very small, and they're trying to gently move towards the door without upsetting the entire market, so that they can get out of this situation as best they can.
Well, David, it's always a pleasure having you on. We'll definitely have to have you back on soon as this all unfolds. But if our viewers are interested in learning more, I know you're on Substack there under Jensen David. Can you tell us a bit more about how people can find you?
Yeah, I would just say Jensen David, Jensen David.substack.com is the best way. And I post my thoughts in there as I see things that need attention. And comment. And again, I'm focused on the physical. I'm not so focused on price charts, etc. But I see the fundamentals as driving this market. And I think that's where we get our most valuable fundamental information.
Fantastic. Once again, David, thank you so much for your time today, and God bless.
Thank you, Ledger. It's my pleasure.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 17th through November 24th, 2025, while supplies last. First this week, backdated 1-ounce gold buffalo are just $320 over spot per ounce. Next, pre-1933 MS63 $20 Liberty coins are just $150 over melt per coin. And finally, 1-ounce 2025 Silver Eagles are just $7.85 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.